Bernie Madoff was a well-respected figure on Wall Street. Known for his charm and financial acumen, he was a man who seemed to have it all. He was born in Queens, New York, in 1938. Growing up in a modest neighborhood, Madoff's early life was far from the glitz and glamour of Wall Street. Madoff started his career in finance in the 1960s. He was ambitious and driven, quickly making a name for himself in the competitive world of stock trading. He founded his own firm, Bernard L. Madoff Investment Securities, in 1960. The firm began as a small penny stock brokerage, but Madoff had bigger dreams. Madoff quickly gained a reputation for generating impressive returns. His investment strategies seemed almost magical, consistently outperforming the market. Investors, both big and small, flocked to him. From individual retirees to large institutional investors, everyone wanted a piece of the Madoff magic. He seemed to have the Midas touch. Every investment he touched turned to gold, or so it seemed. Little did they know, a dark secret lurked beneath the surface. Behind the scenes, Madoff was orchestrating one of the largest financial frauds in history. Madoff cultivated an aura of exclusivity. He made his clients feel special, as if they were part of an elite club with access to unparalleled financial wisdom. He was known for his quiet demeanor and air of confidence. This calm exterior masked the turmoil and deceit that lay beneath. He boasted a star-studded clientele, attracting celebrities, charities, and even other hedge funds. His client list read like a who's who of the financial and entertainment worlds. Madoff's success seemed too good to be true. Sadly, it was. The entire operation was a massive Ponzi scheme, built on lies and deception. Investors' money was not being invested, but rather used to pay off earlier investors, creating an illusion of profitability. When the scheme finally collapsed, it left thousands of investors devastated. Lives were ruined, fortunes lost, and trust in the financial system shattered. Madoff's fall from grace was swift and brutal, culminating in a high-profile trial that captivated the nation. Bernie Madoff was sentenced to 150 years in prison, a stark reminder of the consequences of unchecked greed. His story serves as a cautionary tale, highlighting the importance of transparency and integrity in the financial world. Today, Wall Street continues to evolve, with new regulations and safeguards in place to prevent another Madoff-like scandal. Investors remain hopeful, but the shadow of Madoff's deceit lingers, a reminder of the dark side of financial wizardry. A Ponzi scheme is a type of investment fraud. It relies on attracting new investors to pay off older ones. Money from new investors is not invested as promised. Instead, it is used to pay returns to earlier investors. This creates the illusion of a profitable investment. Ponzi schemes are unsustainable. They require a constant influx of new money. When the flow of new investors slows down, the scheme collapses. This leaves the later investors with significant losses. The exact origins of Madoff's scheme remain unclear. Some believe it began in the 1970s. Others argue it started much later. What is clear is that Madoff was running a legitimate investment firm alongside his fraudulent activities. This made his scheme even harder to detect. Madoff's early investors were likely unaware of his fraudulent activities. They received consistent returns, fueling his reputation. This attracted even more investors, drawing them into his web of deceit. As Madoff's reputation grew, so did his scheme. He attracted investors from all walks of life. Celebrities, charities, and universities entrusted him with their money. Madoff's firm became one of the most respected on Wall Street. Madoff lived a lavish lifestyle. He owned multiple homes, yachts, and expensive jewelry. His family also benefited from his ill-gotten gains. All the while, the foundation of his empire was built on lies and deceit. Early warnings ignored. Over the years, there were warning signs. Some financial analysts questioned Madoff's consistently high returns. They pointed out the lack of transparency in his investment strategies. However, these warnings were largely ignored or dismissed. Madoff's reputation and influence protected him. Investors were blinded by their trust in him. They were reassured by his calm demeanor and confident promises. However, the cracks were beginning to show. The walls close in. The 2008 financial crisis and Madoff's undoing. The financial world was already on edge, but no one could have predicted the seismic impact that was about to unfold. The 2008 financial crisis proved to be Madoff's downfall. The collapse of major financial institutions sent shockwaves through the global economy, and the ripple effects were felt by everyone from small investors to large corporations. As the market crashed, investors began to withdraw their money. Panic set in, and people scrambled to salvage what they could from their investments. The once bustling trading floors turned into scenes of chaos and despair. Madoff was unable to meet these withdrawal requests. His Ponzi scheme, which relied on a constant influx of new investments to pay returns to earlier investors, was unsustainable in the face of mass withdrawals. His scheme, starved of new investments, began to unravel. The financial documents that once painted a picture of success now lay scattered, revealing the grim reality of his fraudulent activities. With mounting pressure and nowhere to turn, Madoff confessed his crimes to his sons. The weight of his deception had become too much to bear, and he could no longer keep up the facade. They, in turn, informed the authorities. The legal machinery quickly sprang into action, and the investigation into Madoff's operations began in earnest. The world watched in disbelief as the truth about Madoff's empire of lies was revealed. News outlets around the globe covered the scandal extensively, and the public was left grappling with the enormity of the fraud. Madoff's confession and arrest. On December 11, 2008, Bernie Madoff was arrested. He confessed to running a massive Ponzi scheme. The news sent shockwaves throughout the financial world. It was one of the largest financial frauds in history. Madoff's confession was shocking in its simplicity. He admitted that his investment fund was a lie. He had been paying old investors with money from new investors. There were no real investments. The scale of Madoff's fraud. The scale of Madoff's fraud was staggering. Investors had lost an estimated $65 billion. Thousands of individuals, charities, and institutions had been swindled. The true extent of the damage was difficult to comprehend. A team of investigators began the daunting task of unraveling the scheme. They pored over years of financial records. They interviewed Madoff and his associates, trying to understand how he managed to deceive so many for so long. Justice served, Madoff's sentence, and the aftermath. In 2009, Bernie Madoff pleaded guilty to 11 federal felonies. He was sentenced to 150 years in prison. The judge called his crimes extraordinarily evil. Madoff's sentence offered little solace to his victims. Many of Madoff's victims were left financially ruined. They lost their life savings, retirement funds, and homes. The Madoff Victim Fund was established to help compensate those affected by the scheme. The impact on victims and the financial world. The Madoff scandal left deep scars on both individual victims and the broader financial landscape. Many investors lost their life savings, and the emotional toll was immense. The Madoff scandal had a profound impact on the financial world. It wasn't just about the money lost, it was about the trust that was shattered. Investors who once believed in the stability and integrity of the financial system found themselves questioning everything. It shook investor confidence and led to calls for increased regulation. People demanded more stringent oversight and better protection against such fraudulent schemes. The financial community was forced to take a hard look at its practices and the gaps in its regulatory framework. The Securities and Exchange Commission, or SEC, faced criticism for its failure to uncover Madoff's scheme earlier. The scandal exposed significant weaknesses in the regulatory system, prompting a re-evaluation of how financial oversight is conducted. The Madoff scandal served as a stark reminder of the dangers of unchecked greed and the importance of investor vigilance. It underscored the need for individuals to be more cautious and informed about where they invest their money. It highlighted the need for transparency and accountability in the financial industry. The scandal led to a push for more open communication and honesty in financial dealings, aiming to rebuild the trust that had been so severely damaged. The lessons learned from this scandal continue to influence financial practices and regulations today, ensuring that such a devastating event is less likely to happen again. Lessons learned and preventing future Madoffs. The Madoff scandal offers valuable lessons. Investors must be wary of promises of consistently high returns. They should thoroughly research investment opportunities and ask questions. Regulators must be vigilant in their oversight of the financial industry. The scars of Madoff's deception will linger. However, by learning from this experience, we can strive to prevent similar tragedies from occurring in the future. The fight against financial fraud requires constant vigilance, education, and a commitment to ethical behavior.